I'm technically a neutral zero right now. I like to teach people to give their technical bias a rating based on numerical performance. And a zero is right in the middle. Plus one is slightly bullish. Plus two is very bullish, moderately bullish, I should say. And plus three is aggressively bullish. I still have it as 0 to a plus one, Matt. Zero because we're in the compression range. But like you've just drawn there, a higher low situation is potentially developing. I just don't think any technician would look at that and say it's aggressively bullish. I'm more of a
No.
neutral right now.
When you're still underneath your resistance zones and you're still above your support zones, you're in a situation where the market where it really could pop either way.
Mm-hmm.
And I know that's not what people want to hear. People want to hear let's go buy right now, or let's go sell right now, but that's not the market we're in right now. It's a very difficult market. It's a news-driven market. We're dealing with tremendous amount of political uncertainty, both foreign and both domestic and abroad. You've had some major resignations coming out of the Trump administration with, Tillerson last week. More coming in expected, including McMaster from the NSA and whatnot. So there is uncertainty right now, it's political, it's uncertainty, it's economic, it's uncertainty, it's Fed, it's uncertainty, and we're getting back to a market that is very uncertain. And I come back to the same things that I said, last month. We're seeing the beginnings of the end of this marketplace. That's what we're seeing. We're seeing the beginning of the end. We are not seeing the end yet. You're seeing the beginning of the end. And that doesn't mean the market's going to tank. That doesn't mean it's going to go down overnight. But what it means is you should prepare for that. And there's nothing in the last month that I have seen that has come off the fact that I still think it is a wise move to think about insuring that portfolio long term.
No, insurance is always on the table. In fact, the newsletter map that we wrote over at Trading Justice for the month of March talks about insurance in your portfolio and how distributions of volatility can be measured. So definitely go check that out if you're out there listening. I agree that insurance is definitely available, but I'm also not aggressively bearish based on this action here either.
No, it's uncertain.
100% uncertain, and until we get more confirmation from price action, some kind of volatility like we saw early February, to me, this is more like normal market behavior. See, if you're a new trader in the first couple of years of watching the market, you probably feel like things are a lot crazier than they were last year, and that's true. They are. Things are more volatile, but frankly, in the history of markets,
it's normal.
It's normal. We get back and forth. So I think you got to take it day by day and keep applying your systems and whatnot. Let's move on to the volatility index, Matt. Stock prices are on a pullback, which is always going to make the VIX spike a little bit. The VIX being that, fear measure, the options measure. Here we are at 1902. Selling options. Are you a premium seller when you see the VIX around 20? What are you thinking here?
I made 5 trades today. They were all selling, Tim.
Okay.
Yeah, I'm definitely a seller here. I think it's wise to cover long-term positions in terms of your covered calls, your long-term stocks. I think it's wise to, like I said, if you're in a situation where you can't say for certain one way or the other where the market's going to go, I think being able to sell credit spreads is a wise thing to do. With volatility spiking like it did today, really ever since it did last in early February, the VIX has been above 15 ever since then, Tim. And ever since then, you've been getting pretty good premiums on calls and so on and so forth. Like for example, you take a situation like U.S. Steel right now, right? Coming down the same thing that a lot of the other market has done. Really like this kind of setup, by the way, on U.S. Steel. But when you're looking at that, you could buy U.S. Steel right now for $39.06. You could rent out the 0.39 delta for basically $143. You're talking somewhere around 3.2% in terms of ROI on that. If you're looking at U.S. Steel with volatility at 10, you're talking getting 2.5% ROI on that. On a credit spread on crude oil, you're getting 20% right now on crude oil. That's because volatility is up. So when volatility is up, the value of options have a tendency to be higher priced. And since they're inherently overpriced, it is even in a normal environment, Tim, if you're going to be trading options, it's better to be a seller of options than it is to be a buyer of options. But when volatility is higher, yeah, any argument the buyer has over on options is probably offset by the cash flow you get from the sell.
Mm-hmm. Yeah, I like cash flow strategies in general. Whenever the VIX starts to creep up in that 19 range, obviously you're going to get more premium. US still on that Tackle 25. Tackle 25 is a wonderful list for cash flow and option selling over at Tackle Trading. Crude light, Matt, $62, stuck in a range. We were talking about it, and Coach Greg was mentioning on the commodity report for the last month or so that you've got a real battle zone at 60, okay, for the price on that side. And you've got another support zone down at 58, no doubt about it. But 60 would be where our support is. Then you've got some resistance zones up here that are kind of tricky to identify. Is it 62.50? Is it 64? How do you read the support and resistance here for crude, Matt?
These are tough signals to buy. We talked about this a little bit last week in the coaches show in Tackle Trading. When you're breaking out of an all-time resistance zone at 66, not all-time, but if you're breaking out of the major resistance area of 66, that's an easy breakout to look at. When you're looking at a potential breakout of this, you can see I drew this line last week. Is it breaking out of that line? Yeah, it is. This is a trend line. It's breaking out of that line. But then it breaks out of that line. You have this minor level of resistance at 63. You have an intermediate level of resistance at 64. And you have a top-end resistance at 66. And so today when I'm looking at crude oil and I'm saying to myself, well, how do you want to play crude oil here? Could you buy that breakout? Absolutely. Right? Good support bounce at 60. It's held very good. It's breaking out of that trend line. But if you buy that, you're competing at 62.5, 63, 64, 66. There's so much in front of you that could stop this from going up. To me, selling a 56 put option 30 days out, cash flowing 20%, that makes more sense to me right now. Selling a bull put spread with a $56 put option, that makes more sense to me. So if you take the directional risk, yes, I think you could justify a buy on crude right now. But for me, as the trader goes, who doesn't care so much about, direction, but, just making the right decisions more than anything else, coming down and looking at that $57 put option and right-clicking and selling a credit spread that you and Tyler are talking about later today in the podcast. Look at this list, Tim. Just on one contract, so we can kind of see how it works. One contract, you're only receiving 7 cents, right? That's not a lot of money, is it? Well, guys, you're talking about the futures contract. That's $70 max profit, and the buying power is 155. Do the math. To me, that is a much better trade, a higher probability trade. You have 89% probability of success based on the Black-Scholes model of Delta. You're getting $70 credit on $153 in buying power. Yeah, I think that to me is the better way to play it.
I like low delta credit spreads, and I've been playing those on crude for a bit now. I mean, that's been a pretty historically a good liquid commodity to work with, no question about it. And crude oil has been range bound. You got to remember, if you're trading crude oil every Wednesday, you've got the EIA numbers. Keep an eye on any news coming out on rig counts or things like that. But also, if you are trading the futures market, I do have to make a reminder here that has volatility. It also has expanding margins, and you need to be an advanced trader.
You're also dealing with non-standard, like you said, you're dealing with non-standard options.
Yeah, for sure. Yeah. All right. Let's go on to take a peek at the gold contract. I always like to look at least the metals. I know that I look at gold and silver personally, but we're looking gold here. Gold's been stuck on support. We talked about it. I had some concern about it last week. We've now seen some pressure, but it is holding support, Matt. You think 1300 or 1310? How would you identify that support right there?
I personally have it at 1300. Is my support level. Obviously, we see this 1310. There's no doubt about that. But you got 1300 over here. You got 1300 over here. You got 1300 back here as resistance as well. it's a significant whole number, and we're only looking at about a few months of data here. But if you go over here to last year, Tim, you can see 1300 is very important here, 1300 is very important here. I think that significant whole number of 13 is very important. So even though you have current support level right here in the 1310 mark, to me that 1300 mark is really the deal, which basically means to me, if you're going to buy gold based on the fact that you think it's holding support here, stop loss still has to be underneath 1300 in my estimation. That would have to be the support level. I'm not a buyer here though, T. Not in terms of the paper assets. Physical asset, that's a different form of analysis altogether. But in terms of the paper asset, trying to just take money on direction, yeah, it's holding support, but holding support isn't good enough for me right now in this market.
I've got concerns about the gold chart. We've talked about them. I don't have concerns about the physical metal, but we've also talked about that. Let's move on to the last one here. And let's take a look at the dollar, dollar sign DXY. Now, the dollar, the biggest instrument in the world in terms of investment, it is the first domino of all dominoes because it drives interest, it drives commodities, it drives the market, it drives investors. So been stuck. It was very, very bearish to start the year. In fact, it was dropping like a rock. It's had some pressure throughout 2017 and the beginning of 2018. But now we're starting to see some consolidation, Matt. I would not call it bullishness in any regard.
It's neutral.
But it's neutral right now. Short term, intermediate term, are you neutral on the dollar, or do you think the long term trend kicks it down?
Well, I'm still longer term bearish on the dollar, but short term I am neutral on the dollar. If you look at the weekly chart here, you still see tremendous weakness to the downside, Tim. This is a bearish flag pattern, low base breakdown, whatever you're looking at that, but that still is bearish. Looking at the daily candles, you're looking at some neutral, some sideways activity. Wouldn't surprise me to see it get back up into 91, and certainly wouldn't surprise me to go test the lows of 88. I would not touch the dollar coming before Wednesday. I don't think anybody else in the market is going to take a stance coming into Wednesday on the dollar. And I'm certainly not going to take a stance coming into Wednesday on the dollar. I'm going to wait till after the announcement is made, and then I am going to wait till after I sit down and listen to Jerome Powell's his Q&A period. I'm going to take my time Wednesday night to really evaluate how the market responds to what Jerome Powell says. This is his first speech, Tim. We're going to get a lot of speeches from Jerome Powell over the next 4, 6, 8. How many every years, right? I want to see how he handles it. I want to see how the Fed responds to it. And so for me, I think that's what's leading to some of this neutrality on the far right here is just the market waiting. And ladies and gentlemen, that's what the market does sometimes. The market wants to wait. It wants to wait to see the data, and that's kind of what we're seeing here. The S&P 500 is range bound. Crude's range bound. The dollar's range bound. Gold is range bound right now. We're waiting. The market is waiting. It's waiting for something because there's so much out there right now. There is so much out there right now. And so I think we got to wait to see some of this shape out. And when you're looking at specifically the dollar, there's nothing more important to the dollar than interest rates. Nothing is. Everything else is a second, third, distant fourth. Interest rates is everything to the dollar. It's why investors buy the dollar. It's why we get rid of the dollar. It's why we go to other asset classes. We've said many times that if you're going to be a trader or an investor in any capacity, you need to understand the dollar and why the dollar goes up and why it goes down. And when you have the Fed chairperson giving his first testimony on his first, not his first go around, he's been a member of the Fed for a long time. Well, not a long time, but for a few years now. But to see how he handles that in the captain's chair, I think is important.
No question about it. Eyes on you, Jerome Powell. So let's take a look and see what the Fed does. Last one we always want to take a look at is the crypto market, and the number one crypto is Bitcoin in terms of market cap, exposure, and what people know out there. Matt, a lot of negative news on Bitcoin in general the last few weeks.
The doves are gone.
Yeah.
They got kicked out. They can't handle the risk. When things weren't just going straight up and everybody was going to be the next Bitcoin billionaire, everybody just bought. And now Bitcoin has shown some weakness and the doves are gone. So let's get back to what traders do, and traders just trade. They don't get into the what this is and what this isn't. We said it last week. We're a little concerned. We're still concerned this week. You know,
Yeah, chart's not good. I mean, it's not
bad.
It's not bad, but it's not good either.
It's range bound too.
You have a higher low from the lowest point at 58.80, but you have a lower low from that mini pivot on the moving average. You don't have a lot of history and data on the charting here, obviously. Bitcoin's been around for about 8 years, since 2009, but in terms of real data on charting and whatnot, a couple months, from the futures market.
Well, I'll tell you right now, it's range bound, and this is weird, but it's range bound from 6,000 to 12,000.
Yeah, but that's how fast it moves. I mean, 12K is a very key resistance point right here. 6,000 would be a major, major support point.
Yeah.
We're stuck right in the middle of that, 84.40. So cryptos, I mean, good time to research them, good time to talk about them. They're not going away.
CME group. You see this? I need this.
They're not.
That's what I need. Because then I can do whatever I do on crude and everything else. Come on, get your stuff together.